Hey, welcome everybody. I think we've got our ninth episode of The Growth Factor here. Joining myself, Ty Lasater, CEO and founding partner of Lasater Capital. We've got Brian Robb, our managing director, on again. And today we're going to dive into and really focus on um, is Trump going to fire his new Fed chair nominee? Uh, Obviously, he's not firing him already. He hasn't even got him appointed yet. He is not appointed yet. That being said, though, we kind of know Trump as being when he has an agenda, he expects results, and when he doesn't get those results, he's ready to move on. So let's really break down today, Brian. What is it that Trump is looking to get from Kevin Warsh, and what is his expectations? What does he think he's going to do with the economy? What does he think he's going to do in his first 6 months, finishing out 2026 in his new position? And so let's dive in and get started.
Yeah, thanks, Ty. I think, it's important to look at the background because when the announcement was made of the appointment, it had a pretty profound impact on the markets. Precious metals corrected in a pretty significant way, gold and silver. We can talk about, the rationale behind that, but also looking at the background of the Fed nominee. So Warsh was initially elected to the board of governors back in 2006, the youngest nominee in history. So he joined in 2006. I think he was 35 years old. Um, he has been a conservative optimist for managing inflation, but doing it in I think a smart way. Although he has shown, and this is years ago, this is going back, 15, 20 years. Um, he has looked at inflation as being a concern and looking at some of the more macro level events in the marketplace. But ultimately, he has voted to lower rates in the past when he was a member of the board from 2006 through 2011 is when he finally exited it. So a lot of that was due to loyalty. You can kind of see he is very loyal to prior Fed Chairman Bernanke when he was in that position. The markets, I think, again, did react very well when they saw the nomination. Overall, I think it's being seen as kind of a safe pick, is what most analysts are saying out there in the marketplace. I think if you take a step back, also, there's been this long history of independence between the Fed and the administration. And regardless of party, we've always had this, I'll say, tradition of the Fed kind of managing long-term expectations. They have a dual mandate of looking at the macroeconomic environment of inflation, jobless, GDP growth, obviously. They want to manage economic growth. And any administration, especially if you're in your first term, is going to focus more on short-term economic growth, which clearly we've seen Trump be very vocal about that in the past couple of years. And to be clear, for him to nominate someone, I don't think it's being said publicly, but there is no question that there is a litmus test out there of would you be willing to do what I want, which is reduce rates to spur economic growth before we put you into this. There was a couple of people that actually were kind of at the last minute 5 yard line as far as nominations. And I think Kevin fit that bill ultimately in Trump's eyes.
Yeah, absolutely. I mean, Trump is looking to get results and get results quickly. And I was on a news show yesterday out of New Jersey, and we were discussing this nomination. And I think at the end of the day, although it's supposed to be an independent nomination and an independent committee, clearly there's human nature to it. And when there's human nature and the individual is appointed by the administration is certainly going to look for somebody who is going to deliver the results that they're looking for. And when you get somebody in a position where they're able to replace the Fed chair this early in their administration, and put somebody in place that is going to help them accomplish what they're trying to accomplish economically, especially coming out of the inflationary periods that we've seen over the last 3 years, then you've got to find somebody and appoint somebody that's going to make a big, bold move and make that move quickly. And that's something that we have not seen clearly from the current Fed chair. And so, we've seen just kind of a slow rollout, slow approach. And that said, Kevin Warsh was very vocal back in 2008 and 2009 coming out of the subprime crisis. And he was actually against aggressively dropping rates early on, but very different scenario there. We were looking at rates that were at or below zero, but more importantly, what the issue was banks making very terrible loans that we have not seen as much this time around. Now what we're seeing is banks are holding what bad loans they do have on their balance sheet for an extended period of time, and looking for what is going to be their bailout or what's going to be their exit. And so, I think we still have to have interest rates come down a little bit to address and continue to address the ongoing economy and specifically housing. I think we've seen a good management and handling of inflation. Inflation is back down. It's under 3% now at this point. But we still have a major housing crisis. And before that housing crisis can be addressed, we've got to see interest rates continue to come down.
Yeah, I think if you look at the overall numbers, this was as of the end of December, so we'll pull current data for January. Unemployment for 4.4%. Inflation, to your point, was at 2.7%, perfectly within range, actually lower than most developed countries. I think we target about a 2.5%, so we're right in the range as far as it relates to inflation. The key Fed's rate, as everyone knows, is at a target of 3.5 to 3.75. We're looking at a 10-year Treasury at about 4.15, 4.20, and your normal lending spreads of around 1.5 to 2.5%. So we're really getting to kind of that perfect storm, because the other side of this that people are really looking at is the broader equity markets. We've talked about this on prior episodes where equity market valuations are at an all-time high. There's a lot of reminders of what happened for the dot-com bubble, and candidly going back even for the housing bubble. When you look at a handful of companies, and in our case lately, it's the Magnificent Seven. These are the high-tech companies, Meta, Facebook, with valuations anywhere from 40. I think Tesla is over 300 as far as the price earnings valuations. So we're seeing a highly overvalued marketplace, and the market is kind of absorbing that, right? So they're looking at that. I mentioned earlier, gold and silver has been a kind of a traditional hedge. Now, interestingly, they would move inverse to interest rates. So typically, if you look at interest rates being higher, that typically drives precious metals down, and vice versa. Although we've had kind of, if you want to use kind of similar analogies, this inverted yield curve over the past couple of years where interest rates are high, precious metals have performed great the past couple of years. Immediately after the announcement, we saw major downturns. Gold was down, I think, 14%. Silver was down 30%, which is a little unusual, but I think part of that is based on expectations around inflation. Part of that is just behavior. So typically people that have used those as a hedge now see some opportunity to get back into the market. And one of the things we're going to talk about is all of this dry capital sitting on the sidelines waiting for real estate. We've kind of said credit has been king the past couple of years. That's been a good market for investors, but there is a lot of equity, and we're slowly starting to see equity work its way back into the markets because of the types of valuations and the opportunities that we're ultimately seeing for real estate moving forward. So we really are entering this perfect storm of high valuations on the equity markets, great opportunities that we're finding in the real estate markets. And we've always said it's important to rebalance. And of course, you want to buy low, sell high. You want to reallocate your portfolio. So a lot of questions we have from investors is, what should we do? The question is not if, but when there is going to be a market correction, and taking some of those gains and selling high and buying low into an asset class that not only has the significant potential for appreciation moving forward, but offers significant tax benefits and can manage a lot of that volatility. That's going to be the key moving forward.
Yeah, well, I think, and I've said this a number of times that, at the end of the day, Trump is focusing on Main Street, not Wall Street. Wall Street, as you mentioned, is significantly overvalued at this point right now. We know that it's got mirrors and correlations back to, as you said, the dot-com bubble, especially in the AI stocks, and very similar. You've got an AI company or AI products that um, oftentimes many of them are so data driven, they're not selling something immediately. They're not selling a product. And so their valuation is based on the amount of data that they're going to provide to the marketplace at some point in the future. And much like the dot-com bust was, you've got these arbitrarily valued companies that it's very difficult to correlate exactly what the value is when there's no revenue. And so at this point, I don't think Trump is necessarily attacking the Fed. I think he's looking to find and hold accountability. And accountability has to be focused first on we addressed inflation, and that was taken care of. Now that inflation is addressed, we've got to bring interest rates down so that Main Street can be addressed. And Main Street being the everyday American. And the everyday American cannot afford housing at this point. We've got such a supply and demand differentiation right now in the marketplace that demand is outpacing supply so bad, and we're not getting any closer. When interest rates are as high as they are and affordability is already out of the picture for end home buyers, developers aren't developing because they can't make money doing so. And so we've got to bring interest rates down where it makes sense to deploy capital back into real estate and build our infrastructure. Then once that's done, accountability then shifts to Wall Street. And by that point, Wall Street will have already naturally corrected itself. And so, as you mentioned, we've got a correction coming. We're setting at all-time highs. And so absolutely it's the time more than ever right now to be reallocating capital that you have from the public equities market where valuations are high into private physical asset backed investment opportunities, and investment opportunities that come with major tax advantages and that are counter correlated to recessions and or corrections that may happen in the equities market, and which we see coming very quickly.
Yeah, I think it's important to also look, another question is, does the Fed have the right tools in their arsenal to kind of manage the type of expectations that the markets and the administration have? And if we go back, really the Fed just has a handful of tools in their toolbox, right? They can manage FOMC, Federal Open Market operations, that the buying and selling treasuries. They manage the Fed funds rate, and they manage the reserve rate. That's it. So they have very limited tools. Now, those tools can have a major impact on overall liquidity and the interest rate environment in the markets. One of the things that I think was accepted or viewed very positively in the market is the nominee does look at broader macroeconomic issues as being important for the government to look at. So it's not just Fed tools, but it's the regulatory environment. It's the tax environment. We've certainly seen some relief there as it relates to the big, beautiful bill, all the provisions that impact real estate that we talked about in an earlier podcast. So there's a number of different things ultimately can impact this environment to spur economic growth. And to your point, there is a big housing crisis. I mean, when families are spending, 30, 40, and sometimes 50% of their income on housing, that's an issue. And so there are tools outside of what the Fed has available to help spur that. New construction starts obviously are a big focus, more affordable housing. There's a number of things that I think needs to be a focus for the administration and the Fed to look at kind of broader set of tools to help manage some of these challenges that we're facing.
Yeah, well, you bring up, the tools, and a question that is been asked, and I was on Stacy on the Right the other day, and she asked me, is the Fed using the proper tools, or are they still fighting the old war in the economy? And as you mentioned, there's really only three tools that they can use. They can go out and buy and sell treasuries. They can adjust the Fed rate, and they've got the reserve. However, much like a hammer, those tools can have multiple different uses for them. And a hammer has a head on it to drive a nail, but it also has a claw on it to open new opportunities, open new doors or new windows, whatever the case may be. And so, I think at this point, they've looked back and they've tried to do everything exactly like they did in '08, '09, or very similar to it. And yes, history repeats itself, and there's aspects of this economy that are mirroring '07, '08, '09, that are mirroring '99 and 2000. However, those um, outlays of concerns in the economy are not being driven by the same core problems that were in those other issues, though. However, and what I mean by that is, '07, '08, '09, we led up to that era with banks and lending policy becoming so light that they were lending 102, 103, 104, and as high as 105% loans on assets at next to 0% interests to unqualified borrowers. And we're not seeing that as much today. Banks learned their lessons a little bit then. However, this time banks are making loans that are creeping up high in value. And so when supply and demand starts to have an impact and interest rates start to climb, we do see operators that have borrowed more than what should have been borrowed. However, by and large, what we're seeing is banks are setting with the assets on their balance sheet looking for an exit timeline. And the only exit timeline is having debt affordable for the current economy. And the only way to have debt affordable for the current economy is we've got to be producing new housing. New housing is so far behind right now that we've got to be producing new housing and or renovating existing housing and existing multifamily. And the best way to do that is to make it feasible for borrowers to borrow money. And right now, that's just not the case. And I'm not advocating for a 0 or a 1 or a 2% interest rate. It needs to be a reasonable interest rate. But when borrowers can borrow in the 5 to very low 6 range, then we can start seeing the economy build back. We can start seeing construction again in the real estate aspect, which number one drives jobs, and number two starts bringing the cost of housing back down to a more affordable number.
Yeah, I think you made a good point, Ty, around the environment with the housing crisis, where you could show 1 month of pay stubs and probably get a loan. And so it's a very, very different environment from a regulatory standpoint. So one of the big differences I think that we're seeing today is there is kind of, or there was, excuse me, this kind of expectation of banks that may be holding assets on their balance sheets that they shouldn't. They were making riskier loans, certainly. Um, you see this kind of ingrained in our culture today. We were talking earlier, not to mention the automakers, but a lot of the big three automakers that we see out there today have cars that have been sitting on the lots for 800, 900, 1,000. There's 2023 new models sitting on dealership lots today because they are unwilling to reduce some of the prices. And candidly, some of the things that are out there are junk. Cars today, I heard this analogy, it's just nothing but a fancy iPhone with an engine. They're kind of designed to be disposable. And I think the thought process is with the quality that we're seeing in some of the automakers today. I personally know a lot of people that they won't even buy a new car. They're looking for good used cars that may have been made 4 or 5, 6 years ago. And I think the thought process is for some of the big auto manufacturers is, well, that's okay. If we overextend ourselves and we create a lot of junk and it sits on the dealer lots for a long time, we'll just get a bailout, right? We're too big to fail. We'll get a bailout similar to something that happened in the bank. I think we're in a different environment today. There may still be some remnants of that hanging on, but banks and other lenders are certainly being a little more cautious to how they are lending out. And so you have a balance between that and, to your point earlier, the need for new housing and the need to approve new buyers because you have so many people that are renting, which is creating a great opportunity for firms like ours. But the need to create overall more affordable housing. And so you have that balance where it's a little bit of a divergence to what we saw during the mortgage crisis.
Yeah, I mean, absolutely. I think at this point we can look back and say the Fed is failing the American middle class, point blank. And what is it that the current administration expects the Fed to do differently? There's a couple of things, but the main thing that we need to see is growth. We've got to see stimulation in the economy. And the best way to do that is for affordability. And, I mean, vehicles is a perfect example of that. I mean, whether you're buying, an SUV or a truck that can pull something, I did exactly what you just said. There was no way I was going to go spend the amount of money on a new truck that they're charging now. I mean, if you want a Super Duty or a heavy duty truck that can pull, whether it's an F-250 or a 2500 or whatever the case may be, or a 1 ton, you're looking at $100,000 or more for a new truck.
Mhm.
And it's obnoxious. I mean, that is just unbelievable. You know, I would rather put that into a new piece of real estate, or I can go buy an exotic car with that kind of money. And there's no reason to be buying a work truck for that kind of money. And so I did. I looked for a used one, found a good used one that had less than 30,000 miles on it. And so, what we've got to focus on is what is going to stimulate the growth here in America. And we're we're seeing a significant spread between the lower class and the upper class that is alleviating the middle class altogether. And it's the middle class that has driven the American economy for 200 years. At the end of the day, it is. The middle class is the blue collar, hardworking class that does manufacture the cars. They're the ones that are on the line manufacturing the cars. They're the service professionals, whether it's HVAC, electrical, plumbing, whatever the case may be. And a lot of those jobs fall within auto manufacturing or construction and or manufacturing for that matter. And so when we're not developing new real estate, new sticks and bricks on top of the dirt that's there, then our jobs and wages are affected significantly. And so the way to drive and stimulate growth is to cut rates faster. And so I think that's what Trump is looking for the Fed to do. It's not just cut rates to cut rates, it's cut rates to stimulate economic growth. And that economic growth is stimulated by increasing jobs, increasing wages, increasing the value in the products that are being delivered, and ultimately creating affordability across America.
Yeah, you're increasing the money supply out there. So obviously, lower rates, other regulatory impacts, like we talked about earlier, is going to free up that capital. And as we also mentioned, there's so much dry capital sitting on the sidelines right now, ready to be deployed, just waiting for some of these indicators. So we kind of are hitting a little bit of that perfect storm. One of the questions we also get is, who's going to win if rates come down faster? Is that going to be investors, and who loses? And I think it's important to look at one of the proposals, and I think this is really a holdover from the thought of continued high rate environments, and that is the notion, we heard the administration bring this up, of the 40 or even the 50-year mortgage, right? As a way to kind of think about affordability. So if you're paying too much per month, you can extend the length of that, obviously, and keep your monthly payment down. But ultimately, between interest and everything that you're paying over the life of that note, it significantly increases the total that you're paying. So I think there are some short-term ideas out there. We could debate all day long whether those are appropriate. But ultimately, I think when you reduce rates further, faster, the investor is going to ultimately win. And those who have a need for real estate are going to win, because it might prevent someone who is considering that 40 or 50-year mortgage from doing something a little more reasonable and getting a 50 or 15, 20 or 30-year mortgage.
Yeah, well, I mean, we saw that in the automotive industry. I remember when I was
Yeah.
when I was a young teenager in high school and starting to look for a vehicle, the primary product was a 3-year product. They were starting to flirt with a 5-year product at that point. By the time I graduated high school, the premier product was a 5-year product. And then I finished college and get a little bit later, and prices of vehicles continue to skyrocket so much and the quality goes down. And all of a sudden they've got a 7-year product, and you can get a 7 up to a 10-year product now. And it's lower quality, higher cost on the vehicle. And as we've already discussed, worse quality. And so at the end of the day, there's no governing factor that is setting what the loan term is. This is a business on the other end of the table saying, how are we going to make money in this business and still manage the right size risk from a given borrower. And so you start looking at banks start looking at a 40 or a 50-year mortgage. And at this point, banks have been around for that much longer, or the car dealer has been around for that much longer. They have that much more liquidity. Their stock price has gone up to what it is today, and it gives them the ability to start changing their product. And they fall to a 40 or 50-year product where maybe they don't get as much up front to qualify that buyer, but now that buyer is mortgaging something with interest over an extra 10 or even 20 years. And so now, at a 6% interest rate, when you get a $400,000 house over a 30-year loan and you pay 800,000 for it, now you're looking at paying north of $1 million on a 40 or a 50-year product. And so what we're going to see is people are going to get into their home and they're never going to be able to get out of it because of upside down value. And the interest on that home is going to cost so much that it's going to outweigh the inflation or the appreciation that they have on that home. And they're going to have to be in it for 20 or 30 years before it makes sense to sell
Right. Yeah, I mean, one of the things, and we'll talk a little bit more about this, is what is the expectation for the rate environment moving forward in 26 and 27? But Ty, I think a good question just based on your expertise is, what do you think investors should do if the monetary policy and the politics collide? If they are divergent, or back to the title, let's say Warsh is nominated and it doesn't work out and they decide to put someone in who's going to be more aggressive. But what should your typical investor do if the politics and the monetary policies collide?
Well, I mean, I think we're already seeing that, which is leading us to this pressure that our current administration has put on the Fed, and now his search for a new Fed chair to replace Jerome Powell in May. And so, what I think investors should do here is really focus on what is going to be the result of this collision that is taking place, and where is it that the current administration is focusing on correction. And they're focusing on correction in Main Street America, which is real estate. That is what is causing the most unaffordability in America right now, and is causing the biggest issues for the everyday Americans. So if Trump is focusing his powers on correcting the real estate market, we know the equities market is going to take a dip. And furthermore, the equities market, as we continue to say, is currently operating on multiples that are exceeding what a reasonable multiple in the marketplace is right now. We're seeing a 4x and 5x multiple on businesses and on equities right now compared to the value. And so with that, we know there's a correction coming. And we know that this collision that has taken place between monetary policy and political policy is focused on correcting real estate. And so if that's the focus, then we know that that's where the money is going to go. We're already seeing other countries pour capital into our real estate market. And again, I was talking about this on the show that I was on yesterday. We've got China. China has decreased their cost of capital. They are focusing on bringing outside capital into China. Once they bring that outside capital in the form of investors into China, they are turning around and deploying that here in the United States on real estate. And you ask why? Because they know that is where the greatest demand on product is right now, affordable product. And so if you watch money and see where money's starting to go from foreign investors as well as the large hedge funds here in America, then that's where you need to be focusing your capital. But it's going to be a short window because once those other countries and once the major hedge funds really focus and get to moving again, then the window of opportunity is gonna close for the everyday investors like yourselves watching this. And so you've got to make a move now, start taking some chips off the table and allocating that into the real estate market that Trump is focusing on fixing right now. Because as we know, it sounds so simple: buy low and sell high. But investors, the everyday investor, gets so scared to take their money out of something that is performing really well right now and move it into something that's not performing well right now. But that is exactly what you should be doing. You should be taking your money out at the top and putting it in at the bottom. And that's where we're sitting right now. But what so many people are going to do is they're going to wake up and their retirement account is going to be reset and they're going to lose 50% or whatever it is of their retirement account overnight. And then they're going to see the window of opportunity in real estate shift up, and they're going to want to take money out once their retirement account in equities has gone down, take money out of that and put it into real estate when real estate has already gone back up. And that's the exact opposite of what you want to do. So right now is the time to start reallocating into tax advantaged assets that are at a low, needing capital right now, so that this Main Street correction that our administration is focused on can start happening.
Yeah, I think the big question we get is what do the next couple of months look like as well. So let's kind of look at the Fed meeting and the events that happen up until June. So the Fed obviously just met, decided not to have any change. The Fed target rate is going to remain stable at 3.5 to 3.75.
Despite inflation and what inflation has done.
Slide inflation, exactly. There are going to be meetings in March and April. If Warsh is nominated, he will take office in June. So if you're familiar, CMA Group, FedWatch does some odds on what they feel like the rate environment's going to look like. They gave it an 11.4% chance of a quarter point cut in March and April. So highly likely we won't. It's a possibility. It's a small possibility that we might see a small cut leading up to Warsh's appointment. But then that goes up to a 47% chance for a 25 basis point cut and an 11% chance of a 50 to 75% cut. So I think most of the pundits would say we're not going to see drastic cuts, but more than likely one cut once he is nominated and in place, probably another cut in 26. And the Fed, during their own commentary, said we kind of feel like one again for next year. So the other thing that has to happen here is we also have to be confirmed. So it's got to get through the Senate Banking Committee as well. Currently, that's made up of 13 Republicans, 11 Democrats. We have one kind of abstainer, Senator Tillis, I believe is North Carolina or South Carolina. He's really going after the current Fed chairman and wants to see that through. But I think eventually he will vote to go ahead and proceed with the nomination. We fully expect Warsh to be nominated by the Senate and then ultimately confirmed again for the upcoming June meeting. So, assuming all of that happens, Ty, a good question for you is, if rates do come down faster than what we kind of anticipated, who do you think wins and who do you think loses in the short term?
Well, I think you've got to kind of look at that from two different sides. And you've got the investor basis, or I'm going to call it the institutional investor basis, and you've got the everyday American. And so, the institutional basis is obviously going to benefit from rates coming down quickly. They're going to have some liquid capital to deploy. They'll be able to go after that lower debt and deploy quickly. You've also got, though, the everyday American that is looking at, so many people have been in their current home since coming out of COVID, needing to or looking to move, and they haven't been able to. And so they're going to be competing they're going to be competing with the lending institutions looking to move homes, maybe buy their first home. And so you're going to see a quick deployment of capital, and then you're going to see a restriction on lending requirements. And so, I think the everyday American does have a negative impact there. However, they have a chance for opportunity because, if an individual is sitting here looking at, okay, I want to buy my first home, but housing is unaffordable today, and all of a sudden, we see interest rates come down and housing becomes affordable. If I'm a young professional at this point and I looked at a graph yesterday and it showed a graph of the United States, all 50 states. And in 2000, it said the states colored green are the states that have an average home price of $200,000 or more. This is in 2000. Zero states were colored green.
Zero.
All
Yep.
all houses were less than in every state. The average
That's
was
that's
less.
California, Hawaii. That's
Correct.
yeah.
Correct. And now it had the same picture and it said and this is 2026, the states with an average home price of less than 200,000 are green. Zero.
Zero.
Because right now the national average is over 400,000. So if you're looking at deploying capital into real estate, I'm not looking at buying my personal home. I'm not looking at and buying my first home. My first home is going to be an investment property, knowing that over 25 years, at a minimum, the value of that investment is going to double. Okay. Now, that's not taking into account how far below $200,000 the average value was in 2000 and how far above 200,000 the value is today. And that number is it's 440 today, and it was about 160 in 2000 was the average. And so that's triple. So in 25 years, if you just start buying a property at a time and holding that for the next 25 years, statistically, that investment is going to triple in value. But if you're living in it and you go to sell that investment, you've got to turn around and buy another one. And so, for me, like I can go rent a extremely nice property, extremely nice 6 to 8,000 square foot house for about $7,000 a month with a pool and everything in it. And I'm not required to maintain or handle or do anything. I can rent, okay, for 7,000 bucks a month. I can also rent a really nice house for $3,000 a month, okay? And then I can turn around and I can invest what I otherwise would have been buying if I were buying that $3,000 a month rental, if I were buying that house is going to be $750,000, give or take. So I'm going to have to go deploy 75 to $100,000 in order to buy that house. Whereas I can go take that same $75,000 and invest in real estate and invest with an operator where I can do it passively. So I partner with somebody that knows what they're doing, that has a career of work doing that, and I can go rent. And now the amount of income that I'm going to make off of that investment is going to cover the cost of my rent for the next decade. And now you've got the flexibility of living, wherever you want to live. You don't have to be tied into your home with a 40-year mortgage for the next 20 years. Now, next year you can decide, hey, I want to move over to a new house. I want to try something out new, or whether it's 2 years or 3 years, whatever the case may be, it's a little bit more flexible.
Yeah, I think as we kind of round this out, the other thing that we're getting questions on is what measurements do you think Trump is going to have for Walsh or any future chairman for that matter? So, if he treated this nominee as a CEO, what are some of the KPIs, that I think are important? And, the top ones that come up, inflation is going to be important, right? We'll look at unemployment. Obviously, we'll look at the interest rate environment. I think overall job growth, potentially the equity markets, but any feedback on what you think, other KPIs might be important for Trump to look at as he looks at the ultimate performance, call it in 6 months after the nomination is sealed?
Yeah, well, the normal ones that just jump out immediately are, like you said, inflation, employment, and job growth. What that looks like, and but really, where the focus is and where his focus is, that's different than in times past, is where do real wages fall? What is wages doing? Because that is what is going to drive affordability. And right now, inflation has been so high for the last 20 years, and we have not seen wage growth in the last 20 years. And so Trump, that's one thing without saying I'm attacking and trying to grow wages. That's what he's doing by bringing manufacturing back here, by putting tariffs on imported goods to entice entrepreneurs and business owners to open up businesses and pay for local labor. That's what he's looking to do, is to drive wages. And then the second one is housing affordability, what we've been talking about. I think he's going to look at what's the national wage average, and what is the national home price average across America, and do those line up? Can the average wage afford the average home? And the only way to do that is to bring down interest rates so that developers are developing more real estate, and the supply and demand ratio starts to come more in line. And then as we bring housing affordability back down, and we bring wages up, what that's going to do and what the development is going to do is going to add more jobs. When like right now, I'm at, employment wise, our lowest that we've been in 8 years. Okay. And I'm doing that because of the cost of everything right now. And so we are running more lean than we have in 8 years. And we're not developing as much, we're not buying as much, we're not building as much. And when interest rates continue to come back down, and we've got a big development project right now that'll employ 100 people for the next 2 years. But we're not starting it yet because the rates aren't quite right yet. We've got a number of other construction projects that we would build out and grow and attack much more quickly as interest rates come down. And then we're going to be bringing in more local jobs. And so when developers and builders are building, developing, and constructing, wages go up, and jobs and the job market increases. And so I think those are going to be the two big KPIs that are not mentioned as much, that Trump is going to focus on.
Good. So we really started this with kind of an interesting, title: "Is Trump ready to fire the new Fed chair?" What we've seen in the past is the willingness to make quick corrections if they don't, quote unquote, play ball. So I think it'll be a very interesting couple of months through the nomination process. I don't anticipate there's going to be any big hurdles there. I think the market fully expects, the analyst fully expects for him to be nominated and in that role starting in June. But it's going to be a very important couple of months as we get into the summer and ultimately into the fall months to see how overall monetary policy is going to shape, and combine that with, to somewhat independence, what the overall equity markets look like. We haven't really said this before, but a broader equity market downturn, which is going to happen, can actually be good from an interest rate standpoint environment. Not good overall for the economy, strictly speaking about interest rates. So it'll be interesting to see the dynamics of the broader markets, and then also looking at some traditional hedges like precious metals, which we talked about earlier. So
Absolutely. And I think Trump may do this better than anybody, but Trump, like really good businessmen like myself, focus on 10 moves ahead. What does this decision today do to impact me 6 months from now or a year from now? And going into this presidency and going into when Trump really started pushing on the Fed, he knew he didn't have the immediate power to fire the Fed chair. But what he did know, and this goes back to his willingness to make moves quickly, and it goes back to that hire slow, fire fast. He knew that by putting pressure on the Fed chair a year in advance of the Fed chair's presumed exit, when his term is up in May, then it was going to bring on quality candidates for Trump to start underwriting and looking at who is going to be my lead horse? And we've seen as many as 10 candidates
Yeah.
publicly. He's really discussed and focused on about three of those for the last since probably October. So the last 6 months, give or take. He's really focused on three of those, and he's really taken his time to figure out which one am I going to make the lead horse and nominate. And then we see him come out with that decision, and it's taken him a good 6 or 8 months to finally announce that Kevin Warsh is going to be his go-to appointee. And so now, once Kevin steps in, he's going to be able to prepare over the next 3 or 4 months before he steps in June. And then Trump is going to see really quickly, are we getting the change and are we getting the momentum that we need? And if we are, fantastic. If we're not, he's going to start putting pressure on him very quickly. And I go back to, I use the word momentum. Trump talks about one of his early mentors. And he had it was a guy that Trump really looked up to. But as Trump started to explode his real estate career, his mentors started to decline a little bit. And he had a conversation with him and he said, what's going on? And his mentor said, I lost my momentum. This is all about momentum and using what you have in front of you and at this moment to create momentum that pushes 6 months, 9 months, and 12 months ahead in front of you and continue to make those decisions that are going to allow you to set yourself up for the decisions and the opportunities to fall in place out 12 months from now. And that's really what we're seeing from him. So with that, thanks for joining us today on this ninth episode of The Growth Factor. Again, like I said, we've got Managing Director Brian Robb here at Lasater Capital on with us, myself, Ty Lasater, the CEO and one of the founders of Lasater Capital, along with my brother. But looking forward to hearing from you. Please reach out, interact with us through whether you're watching this on YouTube or one of the social media platforms. Send us questions or comments, and we'll definitely respond accordingly as we can. Look forward to hearing from each of you. Thanks for tuning in this time, and we'll see you next time on The Growth Factor.